Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at super microcomputer.
If you find our talks useful, please consider subscribe, like, and comment underneath. Looking at the charts this week, I feel like I'm watching a heartbeat monitor after a double shot of espresso.
That's a good way to put it.
We really need to talk about Supermicro. I've been staring at this ticker, and it honestly feels like a roller coaster ride in fast forward. We had that massive stomach-churning drop over the last few months where it looked like the sky was falling, and then boom, January 16th hits.
It really is the perfect case study in market psychology, isn't it? It's exactly where, hard numbers and raw fear collide.
Right, but we have to talk about that elephant in the room. That surge on January 16th, that wasn't just normal volatility.
Not at all.
The stock jumped over 11% in a single session, and before that, it was sitting at, 3-month lows. It felt like the market had left it for dead. So what actually sparked that resurrection?
Well, that's the funny part. The spark didn't even come from Supermicro itself.
Oh, really?
It came from TSMC Taiwan Semiconductor. The biggest chip maker in the world essentially stood up and said, hey, everyone, the demand for AI, it's not slowing down.
Okay, wait, let's unpack that because I want to make sure the connection is clear for everyone. TSMC makes the actual silicon, the wafers, right?
They're the foundry.
Yeah.
They make the chips for Nvidia, for Apple, for AMD, everyone.
So TSMC says, we're baking more cookies, and the market immediately looks at Supermicro and says,
well, someone has to sell the cookie jars.
That is the perfect analogy.
It just validated the whole narrative. The fear for the last few months was that maybe the AI boom is cooling off, or that infrastructure spending is hitting a ceiling. TSMC just blew that fear out of the water.
And because Supermicro had been beaten down so badly,
it created this massive coiled spring effect.
Exactly. So it was a psychological shift just as much as a financial one.
Absolutely. Retail investors in particular looked at that TSMC news and their perception it flipped instantly.
Yeah.
They stopped seeing a falling knife.
Which is always dangerous to catch.
Right, and started seeing the most undervalued AI stock on the market. That 11% jump signals a potential bullish reversal.
Yeah.
It's the market saying, okay, the bottom is in, we're ready to break out.
It's wild how quickly sentiment changes. But let's move past the hype for a second. If we are talking about building genuine wealth here, we need to look under the hood. Is this company actually making money?
Oh, they are making money. The growth story here is, honestly, it's staggering. If you look at the fiscal year 2025, revenue hit $22 billion.
$22 billion. And just for context, where was it the year before that?
$15 billion in 2024.
Wow.
That is a massive leap in a single year. And if you zoom in on the recent quarters, the momentum is still there. In Q4 of 25, they did $5.8 billion in net sales.
Which was up from Q3.
Up from $4.6 billion in the third quarter. So, yeah, the sequential growth is strong.
And they aren't slowing down. I saw the guidance for the next quarter, Q1 26, is already at $5 billion. But where is this ship heading long term? Because $22 billion is great, but the stock price seems to be pricing in, world domination.
And management is telling them to expect it. This is where the numbers get really eye-opening and, frankly, a little hard to wrap your head around. For fiscal year 2026, management is guiding for at least $33 billion in revenue.
Wait, hold on. From $22 billion to $33 billion in 1 year.
In 1 year.
That's 50% growth on an already massive base. Usually when companies get this big, growth slows down to like 10 or 15%. You're saying they're going to accelerate.
They are guiding for acceleration, yes. And if you look at projections from places like Zacks, they are even more optimistic. They're projecting $36.46 billion for fiscal 26.
That's a 65% year-over-year increase.
And looking out to 27, they're seeing over $44 billion.
That's just absurd growth for a hardware company. Usually you see those percentages in, software startups, not companies shipping physical servers.
It just speaks to the voracious appetite for data center infrastructure. The guidance for Q2 of 26 alone is set at $10 to $11 billion.
So they're going to do half of their entire 2025 revenue in a single quarter.
That's the plan.
That really puts the scale into perspective. But here is the question that always nags me. They build servers. Dell build servers, HP build servers? What protects Supermicro? Why doesn't a big client just go to Dell? What is the moat here?
This is the critical question for any long-term holder. And the moat isn't just we build servers, it's how they build them. Supermicro has this building block architecture. It's highly modular.
Like Legos for data centers.
In a way, yes. Most competitors build preset configurations. You get Model A or Model B. Supermicro lets you swap out specific components, processors, memory, storage like Lego bricks. This gives them customization that the bigger guys struggle with.
Okay, but the real secret sauce?
Is direct liquid cooling, or DLC.
Liquid cooling. I keep hearing about this. Because these new AI chips run hot, right?
Hot is an understatement. The new Nvidia chips are reaching thermal limits.
No. Well, trying to cool them with just fans is becoming physically impossible. It's like trying to cool a boiling pot of water by blowing on it.
Right.
And Supermicro has specific IP in this area. They can deploy these high-performance, liquid-cooled racks faster than almost anyone else. We're talking weeks versus months.
I want to pause on that speed aspect. Why is that such a deal breaker here? Why can't a client just wait?
You have to think about the opportunity cost. These companies, the Microsofts, the Metas, they are sitting on piles of Nvidia H100s that cost tens of thousands of dollars each.
And every day those chips are sitting in a box instead of a server rack.
They are burning cash. It's a depreciating asset if it's not plugged in. If Supermicro can get those chips online and training an AI model 6 weeks faster than a competitor, that translates to millions of dollars in revenue for the client.
So the moat isn't just the tech, it's the logistics, it's the speed. Precisely. That speed reduces the friction.
Right.
They are capitalizing on the GPU shortage by ensuring that when you do get chips, you can use them immediately.
Okay, I hear the bullish argument, it's compelling, but I have to play devil's advocate here because I'm looking at the margins and they look terrible.
You notice that?
It's hard not to. Non-GAAP gross margins for fiscal 25 were 11.2%. And then in Q4, it dipped to 9.6%. That is razor thin. If their tech is so special, why can't they charge more?
It is undeniably tight. And that dip in Q4 is the main weapon for the bears right now. The reason is the cost of the components. The parts for these AI servers, especially the liquid cooling and the chips themselves, are incredibly expensive.
So they're rushing so fast they are tripping over their own shoelaces, cost-wise.
In a sense. The argument from the company is that this is temporary. They view it as a land grab. They're accepting low margins now to capture market share.
And the bet is, we will eat the cost now to own the customer, and we'll figure out how to make it cheaper later.
That's the bet. But there is another number that scares some people. Free cash flow. Recently, it was negative $950 million.
Whoa, almost $1 billion in the hole on cash flow.
Yes.
Wait, hold on. You're saying they're burning almost $1 billion in cash, margins are dropping, and I'm supposed to just accept that as the cost of growth. That sounds incredibly risky.
It is the risk. But context is everything here. They aren't burning cash because they are failing. They are burning cash because they are scaling. Think of it like a retailer stocking up for the biggest holiday season ever.
You have to buy the inventory before you can sell it.
Exactly. If you want to sell $33 billion worth of servers next year, you have to buy the parts for them today.
Okay, that makes sense. But does that put them in danger? Are they solvent?
They are very solvent. As of June 30, 2025, they had $5.2 billion in cash. Their total debt, including convertible notes, was $4.8 billion.
Okay, pause on convertible notes. Can you just break that down for us real quick?
Sure. It's a way for a high-growth company to borrow money without huge interest payments. Investors lend them money, and later they can choose to swap that debt for stock in the company.
So it's cheaper debt now, but could dilute shareholders later. Got it. But back to the balance sheet, they have more cash than debt.
Correct. Net positive liquidity. And they've strengthened that position recently. They have the runway to execute this strategy.
So the cash burn is a feature, not a bug at this stage.
That's the argument.
Let's talk about how the market feels about all this. It seems to be a real war between Wall Street analysts and, the retail crowd.
It's a classic divergence. If you look at the sentiment data from Alpha Vantage, the weighted sentiment is decidedly bullish, a score of about 0.43. The narrative is overwhelmingly positive.
But the big banks aren't as convinced. They're the ones looking at those 9.6% margins and sweating.
No, they aren't. You still have downgrades from places like Goldman and Mizuho. They are fixated on those margin concerns. They worry that once the shortage eases, Supermicro loses its pricing power.
And the retail investors are just saying, we don't care, look at the growth.
Retail is betting on the narrative. They see Undervalued AI stock. They see the AI tailwinds. They are ignoring the margin compression for now.
Are there any rumors fueling this?
Here's some chatter. Potential expansions in military contracts, for one.
Military interested.
Yes, that would be sticky long-term revenue. And there's also excitement about the transition to next-gen GPUs, thinking Supermicro will be the first to have racks ready, which could accelerate those fiscal 26 beats.
Okay, so if I'm an investor, what's on the calendar? What are the next big dates I need to circle?
The big one is earnings. Q2 fiscal 26. We are watching to see if they hit that $10 to $11 billion sales target.
And if they miss that, the stock gets punished.
Punished is putting it lightly. With this valuation, perfection is priced in. They have to execute.
What?
Keep an eye on industry events, AI conferences, where they show off their cooling tech, and of course the macro picture. Any hint of rate cuts from the Fed helps high-growth tech.
Right, cheaper debt. Okay, we've covered a lot. I need the final verdict. Give me the elevator pitch. Where do we land on Supermicro?
I'm giving this a bullish score of 8 out of 10.
An 8. That's pretty high, considering we just talked about their margins.
It is, but look at the thesis. Revenue doubled year over year to $22 billion. The guidance suggests another massive leap to between $33 and $36 billion. You cannot find that kind of growth at this scale very often.
And you think the margin risk is solvable?
I view the margin pressure as a setup for a turnaround.
Mm-hmm.
This is a multi-year infrastructure boom. As they scale, those margins should creep back up. And that recent 11% surge tells me the market is starting to price that recovery in.
So this isn't a get-rich-quick trade for next week?
No, this is a multi-year hold into that fiscal 27 sales spike. You have to be willing to stomach the volatility. And there will be volatility.
So a bumpy ride, but one that could be worth it if you have the stomach for it.
Exactly. But as always, knowledge is power, but it's not a crystal ball.
Which brings us to the important part. Always do your own due diligence. We are here to guide you through the noise, but it's your portfolio.
That's right. Check the numbers, read the reports, and make your own decisions.
Thanks for listening to Smart Wealth with Joshua. Don't forget to like and subscribe if you enjoyed this breakdown. We'll see you next time.